Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. It's 12th of December 2023 and here are the questions we'll be answering today. Is it the end of small retail loans? Will government's ethanol move fix the sugar supply? How does Tata AMC CIO see markets playing out in 2024? And what is Google's Gemini? The Reserve Bank of India told banks and non-banking financial companies last month to set aside more capital for risk weights. The central bank was concerned about the recent rise in unsecured personal loans. And now, top lenders have asked their fintech partners to curtail issuing tiny personal loans. Paytm has already announced its plan to go slow on sub 50,000 rupee loans. So is it the end of small retail loans? Tariq Ahmad finds out.
In November this year, India's central bank, that is Reserve Bank of India or RBI, told banks and non-banking financial companies or NBFCs to make higher provisions to ring-fence the risk that they may face from unsecured personal loans and credit card loans. The increase in credit risk weight for unsecured loans means that the banks have to reserve more capital for raising buffers to absorb the losses from unsecured loans. Justifying the RBI action, Chief Economic Advisor Anantha Nageshwaran last week said that unsecured personal loans were growing at the rate of 30% and that the RBI increased the risk weights so that banks and non-banking financial companies would moderate the unsecured personal loans. Brokerage firm Elara Securities, in an October 6 note, had said that unsecured loans formed 32% of the total loan portfolio. According to a Reuters report, RBI had in October urged lenders to tighten controls on tiny personal loans too. Just a month later, leading banks have urged their fintech partners to go slow on small lending, which are often used on lifestyle spending. The total value of loans below 10,000 rupees grew 37% in the financial year 2023, while loans of 10,000 to 50,000 rupees rose 48% according to CRIF data. It is most likely because of this sharp surge that RBI had to intervene.
The recent preemptive measures taken by the Reserve Bank in respect of banks and NBFCs were geared towards addressing potential risks and preserving the resilience of the financial sector. We do not wait for the house to catch fire and then act. Prudence at all times should be the guiding principle, should be the guiding philosophy, both for the regulators as well as the regulated entities.
So, is this the end of small retail loans?
I would not say that it's the end of the road for small retail loans, but definitely it will not be, the growth will not be as much as we have seen in the past 2 years. As you have noticed that this particular segment, which is not even 10,000, even much below, I understand that there have been loans given, it's 500 rupees. You know, the college students are going for to the beer pub, to the pub for a bottle of beer. They are taking this kind of loans. It's a no question asked, no security, no collateral.
According to CRIF high-marked data, delinquencies or missed payments for loans under 50,000 rupees were at 8.1% as of June 2023. This is well above the 1.4% bad loan ratio for all retail loans as of March 2023, according to the latest RBI data. According to experts, the rationale behind such a move from RBI is to do with the increased unsecured loans. There have been tendencies of stacking up several loans by the same individual.
That money has been used for various purposes, mostly used for consumerism, some form of consumerism, be it travel, be it purchase of white goods, be it marriages. So I think we are seeing a lot of PLs happening on preempted expenditure. And that expenditure is propelling consumer demand in the country. However, what India can't afford or ill afford is that we are still on a per capita GDP basis, we're a poor country. So generally, our individuals have much lesser buffer. So if they try and lever up too much on credit, which we are not too levered as an economy as yet. But if we keep levering more and more as an economy, the chances of our debts failing are higher. And what RBI is trying to do is trying to use tools that are within their reach to make sure that we are able to curtail some of these things.
According to RBI, India's net household financial savings was at a 50-year low of 5.1% of gross domestic product in FY23. So, there are still a large number of people who may need these small loans for survival and fulfill the urgent needs. According to experts, now they might have to rely on informal lenders with higher interest rates.
It's an evolving scenario. Who will it affect? It will affect the lenders, definitely. They had a great run, so they have to now be cautious because the ball is turning. Regulator is keeping a very close watch. Will it affect the borrowers and how would they manage it? As I said, if it's for genuine purpose and we are curbing the flow, then they will shift to informal segment, because for them money is they want the money, so they go to the informal money lenders. And if it's for the speculative purpose, then it's a win-win situation. That particular phenomenon should come to an end.
Small retail lending has been rapidly growing in India thanks to technology. Experts said that with the increased credit risk weight on unsecured loans, the retail lending portfolio will slow down. But it will bring down the delinquencies and speculative spending like purchasing of white goods. But as the chances of securing a small loan without collateral is going to be narrow, there will be a section of people who will have to rely on informal lenders for their immediate needs.
The central bank, meanwhile, has said that inflation may soar in November and December. The government too looks circumspect. Its list of food staples facing export restrictions is getting longer as general elections are approaching. Export restrictions on sugar were extended beyond October 31st last week. No reason was cited. At the same time, the government also directed sugar mills not to use sugarcane juice or syrup for making ethanol this year. In today's special segment, Ayush Mishra finds out if it is a good idea and will it fix the sugar supply.
Sugar production is estimated to fall in the 2023-24 marketing year. To guarantee adequate sweetener supply for the domestic market and maintain price stability, the government on Thursday instructed sugar mills and distilleries to stop utilizing sugarcane juice for ethanol production. The Food Ministry communicated this through a letter to the managing directors and chief executives of all sugar mills and distilleries. This, however, goes against the government's efforts to reduce the country's dependence on crude oil with a blend of ethanol and petrol. Oil marketing companies are selling ethanol-blended petrol as part of this program. According to Food Secretary Sanjeev Chopra, the production of ethanol from B-heavy and C-heavy molasses is now permitted. There is a push for increased production from C-heavy molasses, with existing orders from B-heavy molasses remaining unaffected. In the ethanol supply year 2022-23, which ended on 31st October, India accomplished a 12% ethanol blending in petrol. The targeted blending objective for the fiscal year 2023-24 is 15%, requiring public sector oil marketing companies to procure approximately 700 crore litres of ethanol. Industry insiders indicate that 25 to 30% of ethanol is derived from sugarcane juice and sugar syrup, while about 45% originates from B-heavy molasses, a sugar-processed byproduct rich in sugar content. The monsoon rainfall in the primary sugar-producing regions of Maharashtra and Karnataka, collectively contributing to over 50% of India's total sugar production, have been up to 50% lower than the average this year, as per data from Weather Department. According to the National Federation of Cooperative Sugar Factories estimate, the country's net sugar production in the current sugar season is 29 million tons, that is 12% down from 33 million tons last year. Within the consumer price index, sugar holds a weight of 1.36%. A shortage would mean elevated sugar prices, and historical evidence indicates that increased sugar prices often trigger swift responses from policymakers. Food Secretary Sanjeev Chopra said sugar production has come down over the past 1 to 1.5 months and is expected to be down in the 2023-24 season. Food and agriculture expert Devendra Sharma shares his take on the government's move to fix sugar supply.
Yeah, it is a right move. I think ethanol can wait. We need to ensure that the country's food security or the sugar needs are first met, because this year we are anticipating about 12% drop in sugar output, which means about a drop of about 40 lakh tons. Or that should be the priority, because to ensure food inflation within the country, it remains under control. I think the best way is to see that sugar exports are curtailed, A, and B also that ethanol can wait. And ethanol in any case is not the right way to use sugarcane. And I have always been saying that ethanol is a project which should be dropped actually.
Co-founder and chief executive of AgriMandi.live Research, Uppal Shah, believes the government's direction to stop producing ethanol from sugarcane juice will ensure sufficient sugar supply to meet domestic demand in light of less sugar production in the country. Going forward, it will be important to see how the ethanol blending target is fulfilled in the current season, with ethanol supplied mainly from B-heavy molasses, broken rice and maize. Unlike sugar price that's tied to demand and supply, government policies determine ethanol price. Each November, the government shares updated rates for ethanol derived from diverse feedstocks like sugar and grains. The 2023-24 ethanol year rates for biofuel from sugarcane byproducts are pending. Presently, prices stand at 65.61 rupees per litre for 100% sugarcane juice, 60.73 rupees per litre for B-heavy molasses, and 49.41 rupees per litre for C-heavy molasses.
For the sugar mill, they've had a couple of good years, and hence it's always been India's philosophy, right, to divert excess of sugar production finally to ethanol production. And hence, when we have a lean season, when there isn't enough sugar supply, it is expected that ethanol would be discouraged, right? And hence, again, it's not a surprise for the sugar mills, given how sugar supplies have been hit. It should have been expected.
Talking to Business Standard, agriculture economist Ashok Gulati said the government direction will help increase sugar supply marginally but delay the achievement of ethanol blending targets. It is a typical problem of the food versus fuel debate, and food will always come first, especially when we are heading for national elections. So, if India wants to continue emphasizing the role of ethanol as a cleaner fuel, how can it be produced going ahead without risking sugar supply?
India is on a wrong track. We don't need to produce ethanol from sugarcane. Sugarcane is a water guzzler. Let's be very clear. The water it takes out is much more, costly in the sense of not only economics but also ecology. Look at Maharashtra. 4% is the area under sugarcane, and it consumes 70% of the groundwater of Maharashtra. Now, please tell me how it is justifiable. How are you justifying, for that matter, that we should go on for ethanol production? I think ethanol production has to be reduced, and we need to take care of the country's need for sugar. That is okay. But going beyond that to see that sugarcane becomes a liability for the country, I think is very unfortunate.
Prioritizing sugar demand over ethanol needs is crucial, experts believe. Sugar mills redirecting sugarcane to B-heavy and C-heavy molasses intended for ethanol are expected to boost sugar production by around 2.5 million tons in sugar season 2023-24.
Clearly, the ruling party doesn't want to take any chances, as 2024 is an election year. But what does the calendar year 2024 hold for the markets? Will the small caps continue their dream run? To what extent will geopolitics impact market sentiment? Will 2024 belong to debt or bond market investors instead of equity investors, as interest rates remain higher for longer? What about FII and DII flows into equities as an asset class. Puneet Wadhwa caught up with Rahul Singh, the Chief Investment Officer for Equities at Tata Asset Management, to find out.
Hello and welcome to the show. I'm Puneet Wadhwa and we have with us Mr. Rahul Singh, CIO of Equities at Tata AMC with us. Hello and welcome. I'd like to start by asking you, how do you see the markets play out in 2024?
So markets are a reflection of the economy, and economy is going through a lot of positive changes in terms of the revival in the investment cycle. So being just driven by consumption, it is moving to driven by investment plus consumption. And I think that's a very good sign for sustaining the GDP growth rate and sustaining the multiples, which are not cheap, but they are not very expensive either. And we expect that the markets will remain reasonably strong and also broad, because most of the investment cycle revival beneficiaries are not just in large cap, but in mid and small cap also. So we expect a reasonably steady to strong kind of a market, with markets being broad-based across market cap categories.
Do you think that they'll see a downside first and then move up?
I think the timing of a lot of things globally is important for that to come out one way or the other. Obviously, I think elections are an event, but before that, we also need to take a call on in the US whether it's a hard landing, soft landing, when do the interest rates start coming down. Because today, what you're seeing is that there is FIS selling primarily from the global emerging market funds, where as the interest rates go high, you see redemptions from emerging markets. So if that starts to even out or smoothen out, you might see the markets becoming stronger, irrespective of the risk of elections. So the timing of a lot of these global changes in the interest rate cycle is what will drive whether it will go up first or go down first. At this point of time, all we can say is that the economy is looking good. The corporate balance sheet is looking good. The banking sector is in good health, and RBI is very, very proactive in terms of controlling any major risk factors which they see. So from a comparison perspective, India is looking very different in terms of what point of cycle they are in terms of the balance sheet and debt levels and the investment cycle revival versus the rest of the world and rest of the emerging markets, especially China.
Are the markets valuation in a comfortable zone?
So right now, I think the risk reward is slightly in favor of large caps. But as I mentioned, it's not that mid caps are very expensive. They are trading at 15-20% premium to large caps. Again, these are not very attractive levels, but these are not levels where I would get very worried either. So I would say that in the very short term, maybe the risk reward is more towards large cap. But if you look at the economy and the changes which have happened in the economy, mid and small cap is where also the more opportunities will emerge over the next 3 to 5 year period, if the revival in manufacturing and the revival in the investment cycle sustains, which at this point of time looks like there are very good driving forces for that to sustain.
So what are the key risks for the markets in 2024, and to what extent are the markets discounting them at the current levels?
Well, the key risk for India always, apart from elections, which is difficult to call, has always been crude prices and what happens to commodity prices. Because end of the day, we are huge net importer of crude, and therefore anything which happens on crude prices, either because of geopolitics or any other risk, can become a huge risk for Indian macros, as well as for the profit growth estimates for the corporate sector, if it is also accompanied by increase in other commodity prices. So these are, I think, two India-specific risks. As far as the other risk is concerned, it's mostly to do with equities in general globally. If there is a risk of event, if there are any global liquidity accidents because of the higher interest rates, then obviously India cannot escape that either.
Will 2024 belong to the debt and bond market investors as rates remain higher for longer?
I think the interesting part about equities is that the economy is going through a lot of changes. So right now it is a tussle between higher interest rates and good fundamentals. It remains very, very difficult to say with certainty whether that will be the case, the question you asked. But the good news is that there are a lot of good changes which are happening in the economy in terms of investment cycle revival, which sustains the GDP growth rate for much longer.
How do you see corporate profit growth play out in FY24 and FY25?
It is in the range of 13 to 15% both this year and next year. And as I mentioned, I think the fact that there is at various points of time either a margin support or a top line growth support, this year has been, a lot of it has come from margins or margin improvement. Next year is where the top line growth should support that. So I would say the estimate should be in the range of 12 to 15% CAGR.
What's your take on flows into Indian equities?
So foreign flows are a function, as I mentioned, of the interest rates. Obviously, the GEM funds would be seeing redemptions at this point in time because of higher interest rates, and obviously India also will see outflows from that respect. But the India dedicated funds are seeing good positive inflows, like the domestic mutual funds. So I think as and when the overall macro in terms of the interest rate cycle reverses, you will see the FIIs gradually becoming net neutral and maybe net positive sometime later next year, in the second half of 2024.
Thank you for joining us today. We hope to see you soon and have a great 2024.
He's making plans for an early retirement. Business Standard.
Let's now move on to our explainer segment. Google's parent firm Alphabet recently came out with its most advanced artificial intelligence model called Gemini. It is Alphabet's highly anticipated AI model, which may blow people off their feet with its reasoning capabilities. Let's find out more about it.
There is no stopping AI. After ChatGPT, which took the world by storm, another advanced artificial intelligence model has come out. Gemini 1.0 is Google's latest multimodal machine learning model that can crunch different forms of information such as video, audio, and text. Google's parent company Alphabet said that this highly anticipated AI model is capable of more sophisticated reasoning and understanding information with a greater degree of nuance than Google's prior technology. Google has been racing to produce AI software that rivals OpenAI's ChatGPT, which was launched about a year ago. OpenAI is backed by Microsoft. Unlike traditional unimodal AI systems, a multimodal system, such as Gemini, is designed to process multiple forms of sensory input simultaneously, similar to how the human brain perceives the environment. Multimodal AI models are trained to integrate and analyze data from multi-purpose sources and in various forms, including text, images, audio, and video. Google conducted several benchmark tests comparing Gemini with GPT-4. Google claims that Gemini achieved a remarkable score of 90% on the massive multitask language understanding test, surpassing human experts with 89.8% score and outperforming GPT-4 at 86.4% score. MMLU uses a combination of 57 subjects such as mathematics, physics, history, law, medicine, and ethics to test both world knowledge and problem-solving abilities. Google said that it had optimized the Gemini 1.0 model for 3 different sizes. Gemini Ultra is the largest and most capable system based on the Gemini 1.0 model, specifically optimized to carry out highly complex tasks such as advanced reasoning, coding, and solving mathematical problems. Google said that the Gemini Ultra will be available to select customers, developers, partners, and safety and responsibility experts for early experimentation and feedback before rolling it out to developers and enterprise customers early next year. The company will launch Bard Advanced, an upgraded version of Google's AI-based chatbot that will give users access to Gemini Ultra's capabilities. The Gemini Pro system uses the Gemini 1.0 model to carry out various tasks such as planning, reasoning, and more. Starting December 13, developers and enterprise customers can access Gemini Pro via the Gemini API in Google AI Studio or Google Cloud Vertex AI. Google is also integrating Gemini Pro to the current version of Bard in more than 170 regions and territories. Gemini Pro-powered Bard chatbot will be only available in English as of now, with plans for expansion shortly. Gemini Nano has been specially optimized to carry out on-device AI tasks efficiently. Google said it can run offline on Android-based smartphones and other devices. Google is rolling out Gemini Nano on its Pixel 8 Pro smartphone, which the company says was engineered to run the on-device AI model. Gemini Nano currently powers features like Summarize in the Recorder app and is rolling out in Smart Reply for Gboard, starting with WhatsApp. Gemini Nano-powered Gboard features will be available on more messaging apps starting next year. Google has confirmed that Gemini will be available in more products and services like Search, Ads, Chrome, and Duet AI in the coming months.
The nation's trusted bank, SBI, the banker to every Indian.
Meanwhile, a recent survey by PwC claims that 51% of Indians believe that artificial intelligence will help them improve productivity at work. Well, that's all for today. For more news, views and analysis, please log into business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.